Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And for those of you that did not join us last week, I do want to welcome Jessica Inskip as our new director of education and product. Jessica, thank you for joining us again this afternoon.
Yeah, happy to be here. Thank you again for the warm welcome.
And today we're here to talk about still the foundations of options trading. Jessica's here going to introduce us on what is arguably one of the most important topics to have in your options trading education, which is understanding calls and puts, because every single option strategy that you'll trade are built on the foundations that you learn from the topics from today. I can't express enough how many investors or traders want to jump into strategies because you learn about those strategies first. But without these foundations, those strategies many times will fall short, or your ability to understand those strategies will fall short. So I find this incredibly important for you on your options education journey. And Jessica will introduce in a minute as far as the education experience that you can expect as she joins us as a new director of education to help you grow from a beginner to more advanced in your options trading. So with that, Jessica, what I want to do is give you a minute to talk a little bit about your background and how you came here to become the director of education here at OptionsPlay.
Yeah, happy to. And thank you again for the warm welcome. I love talking to the OptionsPlay group. They're lovely to work with so far. So it's been a really great experience. I've had over 13 years of experience in the brokerage space, spent a lot of time with self-directed firms. I've had various roles in call centers, even in strategy, product development, but always found myself really gravitating towards education. And I've always had a strong love for the math and data behind things, so which landed on options and technical analysis. And then of course, our relationship when we met at a trade show many years ago and bonded over a trading strategy and talking about gamma, if you remember that. But yeah, it's been a wild ride, but I'm happy to be here.
Yeah, and while Jessica might be new to many of you that are viewing, except for some of you who are at Merrill Edge, you might have seen some of her education. Jess and I have worked quite a bit over the past 5 or 6 years, so I am very familiar with her teaching style, and this is part of why I had brought her on board to help us with in continuing to enhance the education that we provide here for OptionsPlay members. So with that, I think this is a good time, Jess, for you to introduce a little bit about kind of what members can expect from the options education track as you join us as our director of education.
Yeah, absolutely. So here's what to expect today, and our previous session was on the essentials. So together, Tony and I put our heads together to give you a really good educational course track, and we've come up with essential, seasoned, and master. So right now we're on that essential aspect. On our Thursday sessions, we want to make sure that we do this in its linear format, but we'll also sprinkle in some of the advanced stuff so you don't have to wait for that. And perhaps you join that and may not necessarily be ready for that, but some of the other things really build upon it. That way you are. So there's a lot of great content, but we've made sure we put our thoughts together so it really builds. So concepts like Tony was saying earlier that we're going to discuss today actually really set you up for the Greeks. By the end of this, you'll actually know one Greek rather well. I'm just not going to tell you what it is, and it'll come together. So there's a lot of great stuff that we've worked on, and look forward to more content as we put this together and bring it to you guys.
Yeah, I'm very excited to be bringing this level of education to our OptionsPlay members. So with that, I think, Jessica, what I'll do is I'll hand this over to you to jump in right into calls and puts. There's a lot to cover here today, and I will jump back in as we get towards the end of the session, as we look at OptionsPlay and help answer some questions here at the very end.
Yep, absolutely. We do have a lot to cover today. So we'll start as usual with a disclosure. Types of securities forms and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by OptionsPlay or a solicitation or an offer to buy or sell any securities. And this video is not intended to be used for individual tax, legal, or investing planning advice. So as far as what we're going to cover today, we're going to do a review of the call inputs basics. So it's really where we left off last week. I'll do a very brief 2-minute review of that, and we'll go over an options chain. Just want to introduce that to you and some of the data points that are on there and what they're utilized for. We'll look at long and short equity calls. We'll spend the most time on the equity calls, and then we'll quickly go over long and short equity puts from the view of the buyer and the seller, and what you're looking for and how to capitalize. And then at the end, we'll put it all together and of course have Q&A. All right, so this is where one of the last slides that I showed you last week, and something that we tied all together, is the T-chart. So this T-chart is something, like I said, that's actually utilized from a lot of representatives to study for their Series 7. I've seen it all over the trading floors. I have a variation of it that I actually keep on my desk just because it's very helpful. The purpose of this is long calls are on that upper left-hand side quadrant. If you just know long calls very well, everything else is a mirror if you know where everything goes. Long calls and short puts are both bullish. They have something in common, which is the purchasing of an underlying security. One, it contains the right, the other, the obligation. And then the inverse is true for short calls and long puts. So that's the important thing to keep there, is just this quadrant. We'll show it a lot. We're going to use it to add to the Greeks. We're actually going to really build on it throughout this entire series. So just want to make sure that we have this in front of us again. And of course, we're going to dive deeper into all 4 of these strategies within today's webinar. On the options chain, so just wanted to give you a brief view of what to look at for an option chain, since this is on the essential track and it's not something we've shown you yet. So I'll go really quickly through that. Calls are generally on the left, and whichever option chain you use, there's a default state, and it's generally looks about what I'm showing you today, and there are customizable and lots of features and data points that you can bring to an option chain, and there's certainly a lot to go through. Nonetheless, calls are on the left, puts are on the right, your strikes are in the middle. The expiration dates are sorted, so normally you can just choose those, collapse and expand. There's dates to expiration associated with those. On good options chains, you'll see those like here. The last price just means that is the last price that the option was actually traded at. Does not necessarily mean today. If something's illiquid, it's literally the last time it traded. This is the last price that that option traded at. So liquidity is really important with options, which we'll talk a little more detail about. Change is just literally the difference of the last and its previous close. So again, that could be, hopefully it's today if you're at that day, but with illiquid options, it may not necessarily be. And the bid is the best price available for you to sell. So whenever you're selling a security of any type, regardless if it's an option or not, you sell at the bid, and then you of course purchase on the ask. Your volume is just the contracts that literally traded today. So those are contracts that traded throughout the day, only today, something that you'll look at for liquidity. Open interest is the contracts that are in existence. So that's calculated on a daily basis. So volume is something that's constantly updated. Open interest is updated once a day, and there is a formula that shows how many contracts just literally are out there. So those are our 2 indicators that you'll utilize for liquidity. There's other data points on here that I'm not going through, but I did want to make sure that I introduced an option chain to you and what those data points mean and what to look for and what they're used for. I do want to briefly show you OptionsPlay as well. And this is something when I was first introduced to the platform, what I really enjoyed about it. When you are first getting into options trading, or you're trading options in general, and you have that options chain, I showed you a really condensed version. I actually didn't have all strikes displayed, and I had a set amount of columns. There are so many that you can add, and so many varieties on an option chain. And the option chain is the starting point where you go to generate ideas and choose your strike prices to understand what strategy you want to implement. And you do a little bit of math, you'll look at the Greeks to get your optimal strategy. And OptionsPlay does that work for you. That's really a premise of it, or something that I utilized it when I first discovered the tool years ago. So I do want to give you that view. And right here, we have the OptionsPlay ideas. It scans the chain for you and gives you optimal ideas. So I did see a question in there that says, I want to know how I choose my strike prices and after pricing. That's what this tool is intended to do. We'll go through this course and give you optimal entry and exit points and what to do in certain scenarios. If the stock goes against you, with you, or perhaps sideways, we'll ensure that we cover that. But do know that the tool itself is designed to give you those ideas and those starting points. And then there's alerts and so on and so forth to really give you everything that you need throughout that trade. So nonetheless, let's dive into the actual trades. So I'm going to start with a long equity call. I have it listed like you would actually enter into a trade ticket. So if I'm purchasing a long equity call, so remember we spent a lot of time on this last week, that long equity call gives us the right to buy a specified security within a specified time frame at a specified price. If I am the one purchasing the long call or purchasing an option in general, I love to use the analogy that you're in a car. If you're the purchaser, you are the driver in that situation. If you are the person who is selling that contract, then you're the passenger. If you're the driver, you are the one making the decisions, going right and left. For the passenger, you can be aware of your surroundings and get an idea which way the driver is going to go. But at the end of the day, the driver is the one making the decisions and turning the wheel, if you will, stopping, so on and so forth. So the way we'd enter this, I did use Apple. I did pull these a little way, a week ago, but the prices are real this time. That way we can go through them. So if I were to have a long equity call, I'm going to buy to open one Apple call expiring 30 days from now, strike price of 150 for 7. So this contract represents the right to buy 100 shares of Apple at $150 per share at any time up until the expiration date. And I've purchased that right in exchange for a premium, which we discussed last week and how that's comprised of $7. We have to multiply it times the multiplier. So one contract represents 100 shares. So this is going to cost us a total of $700, which is our max risk. So now I'm introducing to you the profit and loss charts here. And these are really great visually, just to understand if you have maximum upward potential, if there is a cap in either direction, and we'll use these a lot as we go through every single strategy. So my strike price is where we begin. This is where my max risk is. So if Apple doesn't move at all, I am going to lose my maximum amount, which is the amount that I spent, so $700. Because I spent $7, I need Apple to move more than that. And remember, that's looking at it from an expiration standpoint, because the options also have time associated with it. So when I purchase this option, there is some time value, and that's something as a call purchaser, I need to recoup. So we'll look at various scenarios and talk about that in detail, but that's the main lesson from last week's webinar, was looking at time and how time and other factors are a component of an options premium and affect it outside of the underlying security itself. So in this case, if I purchased this call, the right to buy at 150 for 7, in order to capitalize on this, at least on expiration, I need Apple to go more than what I purchased it for. So that's where the break even is. And my gains begin as soon as it goes past the strike price plus the premium. And this has unlimited gain potential. So as a long equity call holder, I essentially am wanting the stock to go up as much as possible. I've selected a time frame. It's optimal for you to select a price target, absolutely, even though there's theoretically the long call or the underlying security can go to an infinite price. Is that realistic? Not necessarily. With OptionsPlay, we'll show you tools how to capitalize on that. But the important part is, as a long equity call holder, I am speculative. I am looking for a sharp movement up as much as possible. I want it to go above the price that I paid it for, and I want to do it as quickly as possible. And I want to recap that time value once it hits my price target. So my max risk occurs when I lose the premium paid, which is if the contract remains, or the underlying remains at the strike price. I start making money as soon as it goes above the strike plus the premium that I paid. And then I want it to just keep on going from there. There's unlimited gain potential as soon as the stock moves above 157. So that's in the eyes of the long equity holder. Now I do want to pause there for a second, and I'll throw out a poll. I did just cover long equity calls, and we're going to cover all 4 individual legs within this segment. But I would love to know if you've purchased a call or put option before, and gives me an idea of how detailed we want to get into this. Zero not sure, so that's good. You know if you've traded it or not. All right. You got a good idea there. So most of you had, a few have not. Certainly good to know. Share the results if you'd like them. And Double, for your question, yes, strike price premium only for the long equity call. That is true. Anything above that is premium, but that's based on expiration. So that is your max profit at expiration. If your option is above $7, you're making profit. So know that a part of this is time. So a part of that premium will be decaying. You do need the underlying to move up more than the $7. All right. So let's look at the short equity call. So on the other side of this, anytime you're buying something, someone is selling it to you. And in this instance, it's the short equity call. So if I were to create an opening trade for a short equity call, we'll take the other side of that transaction. We will be selling to open one Apple call expiring April 22nd, strike 150 for $7. So instead of paying $7, the call seller is going to receive that $7, so 700 total. They're on the complete opposite side of that. They are not speculative purely as holding a short equity call. They're neutral to generally bearish. They do not want the underlying to go above the strike. On the opposite end, they want to keep that credit, and the way to create max gain as a short equity call holder or a short option holder in general is to allow it to expire. That's your max gain. So it will expire if it's below the strike. So any option that is, and for the call below the strike, it will expire worthless. So if it's right at 150, that's going to make max profit for the short equity call holder. If it goes down to $100, that will also make max profit. So the person who holds the short equity call is bearish to neutral, and that's important to know. They have the obligation though. So the long call holder has the right to buy 100 shares of Apple at 150 at any time. The seller has the obligation to sell them those shares. And so they're the passenger. Doesn't necessarily make sense to exercise those rights, and we'll go through that with our examples, but it's also something that we covered in the pricing session that I think is extremely important for you to cover. If you didn't watch that one, definitely check it out, because we do build on these. So they are received that credit, want to keep that credit. In exchange for that credit, they have an obligation to sell 100 shares of Apple at the buyer's discretion. They can exercise those rights at any time. The seller has to meet those obligations. Going to the profit and loss, it's actually a similar calculation, just really flipped. So there's limited gain potential. The gain is limited to that premium. So it's really a zero sum. The long call holder can lose the premium. That's their max loss. That's the max gain for the short equity holder. They need Apple to remain at the strike or move lower in order to be profitable. As the stock moves up, that's the way this number line works. This is the underlying security moving up, and profit here and loss here. As the stock moves up, it actually has the same break-even point, because they received $7 per share of premium. They have the obligation to sell at 150. Apple can theoretically go to an infinite price. So that means if they don't own an offsetting position, which is a long call with the right to buy, or actually the shares, they have unlimited loss potential. And this is actually the only option strategy with unlimited loss potential is a short equity call, alone, a naked call. And that's completely the inverse of the long call. And that's why it's important to know the long call really well. So if they have the right, or excuse me, the obligation to sell at 150, they break even at 157 because they received a $7 credit. They can go on the market and buy for 157. They'll have to sell at 150. That's a loss of 7, offset by the $7 premium that they received. And that's why it's the break even. Then the losses can be astronomical, because if they don't own an underlying security, or own Apple in this case, Apple may go to $400 per share. They still have that obligation. And in that extreme instance, the long call holder would probably exercise, or that contract's going to price in the intrinsic value, and this contract would be at an astronomical loss. And there's ways to account for that. But the important thing to know from this is just essentially how that profit and loss diagram works. And we'll go through examples and scenarios just to understand that. So with the short equity call, your max risk is unlimited. The long equity call, your max gain is unlimited. Break evens are actually the same. The max gain for the short equity call is limited to the premium received, whereas for the long equity call, it's the premium paid. So you can see that these mirror relationships start to develop as you look at options. Someone did ask, do you have to own the stock? You do not. It's a completely different strategy that would get you into a covered call. And we've got a great webinar that you can actually find one on the YouTube channel. There's a lot out there that go over that optimal strategy and creating income with covered calls. That's very different, but just looking at it from a fundamental perspective, a short equity call, that's the highest level. If you're naked, that's the highest options level. Usually your firm is going to require an astronomical amount of equity for you to do that, because you can theoretically get into a negative portfolio, and it's something that's really risky from that perspective. But from a purely foundational perspective, it's important to know the mechanics of how that call works. And the way that it's covered is by owning the underlying security. Then if Apple was to go to an astronomically high price, so that extreme circumstance of $400, well, if you already purchased it at 150 or 145, you can offset that. You've completely removed that unlimited loss potential. So the key is having a pre-purchased price. So let's look at some scenarios, and I've plotted that break-even point, and we've got that strategy there. So we're still looking at one Apple call expiring April 22nd, at a strike of 150. That's at a premium of 70. We've got this on the eyes of the long call purchaser and the short call writer. The Long call purchaser is bullish. We're going to say in this scenario that they hypothetically have a $165 price target. And that's important. Anytime you place a trade, it's extremely important to have an exit strategy, both on your upper and lower limits. And that's inclusive of stock as well, not only options, but any type of trading. That's something important for a disciplined approach. So for the purposes of this example, the long call purchaser has a $165 price target. They feel like that Apple's going to hit that within the next 30 days. The short call writer is neutral, maybe bearish. They think Apple isn't really going to go anywhere. They have a 150 price target. They think it's going to be relatively flat. 150 is one of those even numbers where things may not necessarily blow through. Whatever reason it is, these are their views. So both of them place a trade. The long call purchaser buys to open at 7. The short call writer does exactly the opposite. The long call purchaser spent $700. The short call writer received $700. So we can see what happened. And both have break even depending on which way the security goes. So both of them need that to happen. So let's say on day 15, and I'm going to look at this, what happens midway and also at expiration. And again, I pulled prices of what this would happen, so it's more of a realistic scenario. So let's say Apple did what the long purchaser wanted. It did reach 165 before the option expired. So remember when we talked about pricing and how an options premium is comprised. So now that Apple's at 165, if we have the right to buy at 150, that means the intrinsic value of this is at least $15. So if I have the right to buy at 150, can sell at 165, it has to be worth at least $15. That remaining 2 is its extrinsic value. That's because we've got 15 days left until expiration. The long call purchaser, this is the optimal scenario. It hit the strike price, or excuse me, the target price prior to expiration. So now the long call purchaser close those contracts on the market, if the market exists, and recapture some of that time value that was purchased, creating a gain of $1,000 total, or $10 per share. So sold for 17, bought at 7. The short call holder, on the other hand, has the opposite scenario. It did not hit its price target, and the short call writer was in fact incorrect in their sentiment, and therefore had to pay the premium of 17, creating a loss of $1,000 total. So you can see how those scenarios played out. So let's see what would happen if we went to expiration. So the long call purchaser decided that they got greedy, really, which is the worst thing that can happen to you. You have to have your price targets, stay disciplined. It's very difficult to sell on the highest highs or buy on the lowest lows, extremely unrealistic. So those price targets are important. This long call purchaser did not take that into account and held out. The stock did go up $1 more, but it wasn't enough. And now, because the time value completely decayed, like we were talking about last week, they still made money, but they didn't make as much if they would have closed it early. It actually cost them $100. But that helped the short call writer because they want the option to be worthless. So that time decay is actually very important and beneficial. So the short call writer benefited in that situation, whereas the long call purchaser did not. There was a total gain of $900 versus that $1,000 for the long call purchaser for holding it to expiration, and a loss of $900, so helped the short call writer in the long run. All right, and so looking at equity calls, let's look at it at a different circumstance. So same trade place, but let's say now at day 15, it actually was sideways. So this is where the short call writer, they were right with their sentiment, but there has been 15 days past, we haven't reached expiration. Well, the long call purchaser is saying, you know what, I'm not right. this contract. I'm going to keep losing time as it goes. I'm going to go ahead and just close this. I was incorrect in my sentiment. And they received a premium of $5 because that's all the time that was left. And they just capitalized on that. Their loss was $200. Remember, their max could have been 7 in this scenario if it didn't go their direction. But because they closed and captured that time, they were able to mitigate that loss. Do know that if you do close it out, then if Apple were to go the opposite direction and do skyrocket in the favor of the long call purchaser, that could hurt it in that scenario. So it's really important just to have an idea of where the stock's going to go, but also understand how the premium is made up. The short call writer, though, did experience a gain. There's still some time left. If they wanted to close it out at that point, that's absolutely fine. But that's what happened in the view of the short call writer. Now, if you look at holding this until expiration, and it actually went down in value below the strike at this point, both, or the long call purchaser now experienced a much bigger loss because we talked about this last week. The previous example, Apple was at 150, which is at the money, which is where extrinsic value is very centric. It's centric around at the money and the highest at that point. Since Apple now moved down and now it's out of the money and we've come to expiration, there is no extrinsic value that's completely depleted and there is 0 intrinsic value. So there is nothing the long call purchaser can do. They could try to sell it on the market for a penny, probably not going to happen. It's going to be illiquid. It's going to be difficult to close that option. They're going to experience the full loss of $700. So $500 more than the previous, simply because they held up on hope that the security would go up when in fact it did not. The short call writer, though, was receiving a gain and would have received a gain if it remained at 150, but capitalized on that additional time decay and was able to experience max gain because the option went below the strike. So you can see where the trade-off is for the short call and the long call purchaser. All right, and before we go through long equity puts, I will throw another poll out there just to do a little knowledge check. So we want to know, does time favor the seller or the buyer of an option? All right. No, the answers are still coming in. There's a lot. There's actually mixed answers there. Majority is definitely correct. Okay. So certainly it depends on a lot of things. Go ahead and end the poll and I will share the results. But it does benefit the seller. The seller can capitalize on time. Time has a positive effect for sellers. So remember, time is always working against you. I don't have a time machine. I would love one, but nonetheless, it's always moving in a direction against us. And therefore, as someone who purchases options, that's something that you have to really be cognizant of. You want to capture back that time, but it is impossible for you to capture back the time that you purchased when you initially created the trade, because you can't go back there. So that's gonna, if we placed a trade 30 days out, it comes to 15 days, that 15 days is gone and there is no getting that back. And that's something that hurts the buyer. The seller, on the other hand, because they want to keep that credit and they want the option to expire worthless, that 15 days or that time decay in general absolutely benefits them and helps them. That's something that is there on the other side of the coin. And that's where we can look at probabilities and other things as well. But that's the important part with time decay. Time decay is positive if you are selling an option because you want it to deplete in value, and something that constantly depletes is time. For a long call holder, negative, you need the underlying security to move in a sharp direction, depending on if you have a call or a put, and you need to do that before that time is completely depleted. So time is working against you if you are a buyer of an option, working for you if you are a seller of an option. So the answer is the seller in that scenario. All right. So looking at the long equity puts, so now we're going to look at the same thing. And remember, it's just a mirror. And the important thing with options is to really know long equity calls really, really well. If you do that and you have that T-chart, you can figure everything else out if you use that mirror and that illustration that we put together for you. I'm going to go through those same type of scenarios with the long equity put and the short equity put from the buyer and the seller's view. Just remember that the put is, instead of the right to buy, it just represents the right to sell. That's the difference. So we'll just kind of flip everything around. So if I am purchasing one Apple put expiring April 22nd, strike of 150 for 7, it just means that as the put holder, I own the right to sell 100 shares of Apple at 150 at any time until April 22nd. And I paid a premium of $700 in order to own that right. The person who has the short put, they have the obligation to buy it from me. So I'll say I want to go ahead. Apple is trading at a favorable price. I want to go ahead and execute the terms of that. So I sell Apple, you have to buy it from me. That's the difference there. So with the put, the max risk is exactly the same because I'm buying it. I don't have the obligation. I have the right. I'm in control. I'm the driver. I don't have to exercise the contract if I don't want to. Therefore, the max risk is limited to the premium that I paid for that right. So that happens at 150. So right here. Apple, so remember this is like a number line. Apple does need to move more than the extrinsic value purchased. So this is just the other way to 143. So if I spent 7, I need Apple to go down at least 7 at expiration. Remember, time value is still a component of that. And that's where break even is. Once Apple moves below 143, I have substantial gain potential because Apple can't infinitely go down. It can only go to 0. Therefore, my max gain is if Apple is at 0. I guess at that point it stopped trading, completely different story. But nonetheless, if Apple was at a very low price, if I have the right to sell it at 150, I can go to the market and buy it at $1. I just made $149 per share. So there's substantial gain potential for the person who owns the long equity put, but it requires sharp directional movement downward. So we really explained that there. So 150 is my strike. I need it to go below. I would prefer it to go lower than what I paid for that rate. And then as soon as it reaches that point, I have substantial gain potential. Let's look at the short equity put. So to open this trade, you'd sell to open. So we open, if we're buying, buy to open, selling, sell to open. One Apple put expiring April 22nd, which is 30 days from now, strike of 150 for 7. This person has the obligation to purchase Apple at 150 per share at the buyer's discretion, buyer being the person who purchased the contract. And they have that obligation for a specified time frame, which is that 30 days. And they received $700 as they sold that contract to that buyer, not in a literal sense. So now we just flip it and you can see how everything really is a mirror. So the max risk here is substantial because the max gain for the long equity put holder is substantial. This is bullish for the short put holder because we actually want the stock to remain above 150. So remember, the goal for any option seller is for it to expire worthless. You don't want the option to be worth anything. And in order for a short put to be not worth anything, you don't want it to be favorable to execute and have a price to sell at. So that's the important part here. So if Apple needs to remain at the strike or move higher, If Apple is at 160, it makes sense to sell at the market at 160, not if you have a contract that represents the right to sell at 150. So therefore, Apple needs to move higher. If Apple moves higher, that right to sell is worthless, which means the short equity put holder reaches max gain at that point. So we need it to go above here. And this is how you can see that upward potential at a specified price there. It stays the same regardless how high Apple goes. The break even is the same. So you'll see this theme here. If I have the obligation to purchase at 150 and that contract is worth value and it reaches 143 and the person who owns that put decides that they're going to sell at 143, then I may have to buy at 150 and sell at 143. That's a loss of 7. That's offset by the premium that I received of 7. Once it goes past 143 and Apple drops, that's when I have substantial loss potential. So you can see how everything is really flipped there. All right. So let's look at those scenarios. So same thing here, a couple different prices, but I do want you to take away a couple things from here. So if I'm the long put purchaser, I'm bearish. I have a price target, because remember, those are extremely important, of perhaps 135 in this situation. I know I need it to move more than 143 because I purchased 7. I'm going to shoot for 135, and I'm going to do this within a 30-day time frame. And that's how I chose my optimal strikes in this scenario. The short put writer is bullish or neutral because, again, it capitalized on a neutral scenario and has a 155 price target. So in this case, slightly bullish. This short put writer feels like Apple is going to be above 155. And they also feel like this will occur within the next 30 days. Both place a trade. The long put purchaser pays $700. The writer receives $700. See what happens. So on day 15, long put purchaser is correct. And Apple moved to 140, which is past their price target. And therefore, they're like, yo, my price target was hit. I'm going to go ahead and sell to close my contracts for a premium of $11, $1,100 total. Because remember, you have to multiply times the multiplier, which is 100 shares per contract, receiving a gain of $400 total at that time. So in this scenario, they're able to capitalize on time value. And that's an important component here as we were doing that knowledge check. In the long, any long purchaser or long holder of an option has to try to recoup some time value, and that's an optimal experience for them. The short put writer, on the other hand, realized that the option did not go in the direction, so they decided to go ahead and close that option and experienced a loss of $400 at that time. So this is the scenario where time value is still priced into that option. And remember, it's about $1. So there's $10 of intrinsic value here, but only $1 here left of time decay. So going all the way to expiration, Apple is at did not update that there. I'm sorry, this is supposed to say 135, but if Apple's at 135, now it's at 15, the long purchaser went ahead and closed their option, received $15, capitalized on that, and then the short put writer as well. So moving on to a different scenario. So now the Apple is at 143. So it's moved down. This is the break-even point for both the purchaser and the seller. The person who purchased the put has decided to close for 9, so received $900 total, got a gain of 200, and this is an important part here. So remember earlier I said that the break-even point happens on expiration because we're looking at purely intrinsic value. There's still time value. And so the long put purchaser in this scenario realized that Apple is at the break-even point, and if it were to remain there, the only thing that's left in that option is purely extrinsic value, which is going to go away. So if the long put purchaser feels like Apple is going to go up against them, or perhaps even stay sideways. They need extreme movement, sharp movement in order to make money. So therefore they closed it and received a gain of $200 total. The short put writer experienced a loss in this because remember they're bullish. And now that the underlying went down, they experienced a loss. They paid that premium of 9, so the difference of 9 and 7, loss of $200. And that time decay is something that benefited that short put writer. So they would only do this in the scenario where they felt like the underlying was going to move against them. So now looking at expiration, all the way to that end of the 30 days, and we have Apple at 143. So it moved around, went below, but it ended the end of the day right at the break-even point. They both are at break-even, and that's the point I wanted to drive home here, is they probably were able to close them both in the market for around extrinsic value, but since one purchased and the other one sold, they do the inverse on the closing transaction. There's purely break-even that occurred here. So you need movement in order to capitalize. All right. Now, if the underlying security moved above, this is the optimal situation for the short put writer. So remember, they are bullish. The put contains the right to sell if the market is pricing at a higher price, then therefore the put writer capitalizes on that. So they received the premium of 7. They get to keep that premium of 7 because it doesn't make sense to exercise those rights. The option expires worthless. They have their max gain of $700. The person who purchased the put, on the other hand, has their max loss of $700. And I did write out here that they cannot close the option because something is going to happen here on expiration, because both held them to expiration and this contract is out of the money. The spreads tend to get wide. It's a little illiquid, and they're going to have a really hard time even buying to closing or selling to close that option. It's possible, may have to pay money for that, but it's essentially going to expire worthless. So that brings me back to the T-chart that I introduced you to in the beginning that we're building upon, and this is the building upon for this educational piece that I want you to take home. So same thing. This is going to stay consistent. We'll just add a little more to it. So if you are a long call holder or a long put holder, you profit from sharp movement. It's just the difference if it's upwards or downwards. So since you're on the top part, these are our bullish, they profit from sharp upward. A long call holder profits from sharp upward movement. The long put holder profits from sharp downward movement. They need it to move more than the premium that they purchased. And time decay is also negative because I am purchase time. We can't go back in time. It's working against you. You need the option to go up in value. So you needed to go up more than the time value purchased. So time decay is negative for all long options, and you need a sharp movement up or down for the long options. For the short options, it's really the inverse. Time decay is positive. Time is depleting. We want the option to deplete. So any value that is organically depleting in the option is something that we can capitalize on. The options expires, you keep the maximum credit. That is exactly what you want. And both profit from neutral or upward movements. We don't need a sharp movement in either direction. You just need a little bit. You just need it to be above or below that strike. You just want it to expire worthless. You do not want the long holder on the other side to capitalize or have any value. And so that there's sentences here that help with that as far as the goals that are concerned with each respective contract. But long call just wants the stock to rally more than the premium paid. The long put holder wants the stock to decline more than the premium paid, and they need that to happen quite a bit. The short put writer wants the option to expire and keep the maximum credit, and the same thing is true for the short call writer. So this is something that's important, and this is the chart that we're going to keep building upon, and this does really set you up for the Greeks, which I think is important, especially on answering those questions on how do I pick my strikes and what to look at and adjust from there. So that concludes the long calls and short puts and understanding calls and puts in our presentation today. So we'll shift it over to questions and go ahead and type them in the chat if you have any.
Yeah, so please, if you have any questions, feel free to type them into the Q&A section. If possible, we'll try to answer as many questions out of that Q&A section. But I just want to reiterate, one, how important that T-chart is if you're new to options trading, because it is confusing to remember calls and puts, long and short. And that T-chart is really helpful. And as Jess said, print one out. It's really helpful to have that on your desktop or on your desk when you're learning about options to help you remember these concepts. But again, just to reiterate, what you've learned here today, there's a lot that we covered with respect to the different scenarios of being long and short calls and puts. So take the time to watch the recording. We send the slides out to you. There are a lot of questions in the chat during the session as to whether or not you get the recording and the slides. We always send that out to you so that you can review this at your own pace with the slides, print them out, make sure you understand them, because this is arguably one of the most important topics to learn and understand and master in order to continue your understanding of options. So Jessica, thank you so much for taking the time to go through all of those scenarios and the detailed slides that you put together, because I think that will be really helpful for our members to utilize them to master their understanding of calls and puts.
Yeah, absolutely. There are a couple questions out there I would love to answer. So,
sure, go ahead.
Viron, if I'm saying that correctly, is it important to close the trade? Depends on the scenario. If you're the long call holder, absolutely. Or long put holder, any long option holder, just simply because of that time decay. If you are on the short side, anytime you have a short option, you have assignment risk, and which means it could go against you just depending on the scenario. So we'll go through those as far as closing trades when we go into actual strategies. But in essence, yes, in general, if you are a long holder of an option. Can you sell the short put prior to expiration? Yes, and you should, is a one.
Yeah, there were multiple questions regarding that. And the answer is at every single option prior to expiration, you always have the option of closing out the trade prior to expiration. You do not have to hold options to expiration. You can take profits, you can cut losses at any time. You do not need to hold them to expiration.
I see that a similar question again. So you sell the put or any option and you choose your expiration at that time. Once expiration hits, it's not ideal to sell an option at that time. Very difficult to capitalize on that. You take the entire premium, but you may have to buy it back at some time. And that's when you offset and determine your gain or loss. So you sell for a credit, you immediately receive that. You receive the full credit, and that's determined by the price, which Tony and I covered in the last session. And you may hold that to expiration if it's moving in your favor. You may not, but you receive that full premium up front.
Yeah, and Jess, if you don't mind bringing up that first slide where you go over what the members can expect from an education track perspective, there's a couple of questions regarding, are we going to talk about spreads? Are we going to talk about leaps? And the answer is yes, we're going to talk about all of those strategies. I can send you a link to a recent webinar we hosted on leaps, but Jess will show you a slide that will show you what you can expect to learn from us. But like I said, in order to really understand spreads, understand that spreads are built on these four foundational tools, if you will: long call, long put, short call, short put. Every single spread is built from those four combinations. So in order to really understand those spreads, you have to understand the topics from today. But the answer is yes. We will talk about debit spreads, credit spreads, calendars, diagonals. We even get into 3 and 4 leg spreads like butterflies and iron condors. And leaps are really just long dated call options, but we did host a webinar on that recently, and I can send you that link to see the webinar that we've recently hosted on leaps.
Someone asked about the Greek you learned today. There is one in there. I just wasn't going to tell you what it was, but yes. Set you up for 2, actually, really 3. What if the stock at the expiration is exactly the same as the strike? Will you get assigned? Most likely no. The rule is that it has to be in the money by at least a penny. However, the OCC does accept exercise instructions until 5:30, which means if there's any post-market activity and it makes sense for the long option holder to exercise, you could get assigned, but it's unlikely. It's just something to be cognizant of if you have a short option and it closes at the money.
And Ken's asking a great question. When you're in a position, what is the amount of profit or loss you should take to get out? So Ken, I would say that heavily depends on the strategy. And this is why we do education on each individual strategy. But Jess and I are currently in the process of putting together a knowledge book to go over some of the best practices for the common strategies as to when it might make sense to take profits and cut losses. So those are some of the things you can expect from us going forward.
Mm-hmm.
Joanne, your question regarding registered accounts, you are going to be fairly limited in terms of what you can trade in those registered accounts. As the buyer of a call or put, do you follow the strategy to exit 30 days till expiration? I'm not sure I fully understand that question, Dovel. If you don't mind clarifying, I'm happy to try to answer that question, but what do you mean by follow the strategy to exit 30 days till expiration? Wayne, that is something that we are currently working to add, which are the Greeks for each leg and the portfolio Greeks as well. Hi,
can you elaborate on your question? Can we exercise and sell a long call option at the same time? Can't necessarily sell a long call option. So when you purchase it, you are long. If you sell it, you are short, just like with stock. Depending on what you hold, but I'd love some clarification on what you mean.
Any other questions? You can type your questions into the Q&A window. We'll try to answer your questions before we sign off for today.
All right, give it 30 more seconds.
Bunch just came in. Regarding the question about a cover call, if you've sold a cover call and the stock continues to move higher, the question is, what is it that you do? Generally speaking, the rule of thumb is that if the stock has moved substantially higher after you've sold the cover call, you generally don't do much until the last couple of weeks to expiration. And it really just depends on whether or not you believe that there's further upside here in the underlying stock itself. If you believe that there's new information and your original target price you think is conservative and you think the stock can continue to move higher, buy back the short call and sell perhaps a higher call, or simply just leave the stock uncovered. But if you feel that you're comfortable with taking profits and the stock has exceeded your expectations, it's never a bad idea to take profits and have the stock get called away. You should never be sad, if you will, or bummed out that the stock got called away, because that generally means that you've made a profit. At what situation does it make sense to sell an in-the-money cover call or at-the-money cover call? So I would say that it never makes sense to sell an in-the-money cover call because there's no extrinsic value. That's the whole point of selling a call option, is to capture the extrinsic value. You have very little of that when you sell an in-the-money cover call. There are some cases where you might want to sell an at-the-money cover call, and that's generally speaking reserved for when you feel the stock is at the very upper bound of its range and you want to capture as much premium as possible and you want to hold on to that stock for the long run, but in the short run you want to make some fat juicy profits, if you will. That's really the only scenario, in my opinion, where you would sell an at-the-money call option on a cover call.
There is a video out there. Oh, go ahead.
No, go ahead.
I saw a question on the new OptionsPlay platform. Tony recorded one last week, and it's on the YouTube channel in depth. I believe it's called Unveiling the New Platform, so you can check that out.
I will post a link into the chat window for those of you that want to check out the new platform. Just posted that link into the chat window for anyone who's looking to explore the new platform. When is the best time to exercise the in-the-money call? Generally speaking, the best time to exercise an in-the-money call option would be at expiration.
As long as it makes sense. Usually you can close it for its intrinsic value.
So Dovel, your rule of closing long calls at 30 days to expiration, that is a fairly common rule. As far as, different traders will use different time frames. Some will use 21 days, some will use 30 days. But generally speaking, the rule of thumb of closing long calls 30 days before expiration is to avoid the acceleration of time decay that you see in the last 30 days. So that is a rule that is fairly common. And different traders have different thresholds as to when they want to close out those trades. But that type of rule, in my opinion, is quite common and popular.
Great.
Are only long calls a good or bad decision? Long calls have their benefits, but in the long run, choosing stocks that you think are going to only go up that are going to exceed what the market expects that stock to do in the future is a very difficult strategy, because what you're paying for in an option is basically the time premium, and the time premium is based on what the market expects the stock to do in the future. And what you are expressing when you buy a call option is you believe that the markets are wrong and that the stock can move more than what the market historically has done. And that is something that you can do from time to time when you have a catalyst like earnings coming up, or you have a statistical edge from a technical perspective, but it's difficult to do that all the time. So I hate to say that it's good or bad. I like to use the term that, there are potentially better ways that you can take some bullish exposure or bearish exposure, but doing so using a spread. That'll allow you to kind of get the benefits of buying calls and selling calls at the same time in a single strategy. And we're going to explore that. And I spent a lot of time teaching this stuff, and Jess and I will teach them in the spread classes. So with that, I do want to just say, for those of you that are currently members of OptionsPlay, I want to thank you for your support and allowing us to continue to do this and bring on fantastic educators like Jessica onto the team. For those of you that are currently on a free trial, I hope that you are enjoying your trial and getting access to the tools and the education that you need to help you improve your trading. If you're brand new to OptionsPlay, you can sign up for that 30-day free trial at OptionsPlay.com. It gives you access to everything, including these Thursday education sessions hosted by Jessica and I, to Monday macro research from Rick, our chief market strategist, and our daily play trading signals, including the OptionsPlay platform. So that is all available to you at OptionsPlay.com. With that, I just want to thank everyone for taking the time out here this afternoon, and I want to thank Jessica for going through the topics here today. Thank you so much, and I hope everyone has a great trading day. We will send you both the recording and the slides after today's session.